November 2022 is a month that investors, particularly in cryptocurrencies, will never forget. And the worst may be yet to come. Over the past 2 weeks, the digital asset industry has watched in horror as FTX, the multi-billion-dollar crypto exchange created by one of its biggest and brightest stars, Sam Bankman-Fried, imploded. The failure of FTX shook the foundations of the entire cryptocurrency ecosystem. Token prices tumbled across the board as investors rushed to exit risky positions. Contagion followed. In the panic, depositors scrambled to pull their money out of various crypto platforms, forcing lenders to halt withdrawals, what one industry watcher described as going on death watch. Overnight, Bankman-Fried went from hero to villain. It's a collapse that some have called crypto's Lehman moment. The bankruptcy of the crypto giant FTX and the resignation of its founder, Sam Bankman-Fried, has left customers in limbo and investors writing off what once looked like the next big thing in tech. And it happened in a matter of days. But in the complex world of crypto, such a collapse can be hard to parse. Here are the basics of what went down. Also, these are the exact things I will quickly cover in this summary video. 1. Quick recap. 2. How did it become so big? 3. The first red flags. 4. FTX House of Cards. 5. Investigations and regulatory scrutiny. Other bonus explanations will include, can crypto survive after this mess? Quick recap. On November 2nd, an article from the crypto trade publication CoinDesk cited a leaked financial document that raised questions about the relationship between FTX and Bankman-Fried's trading house, Alameda Research. On paper, the two companies appeared separate entities that happened to be owned by the same man. But the CoinDesk article said that Alameda rests on a foundation largely made up of a coin that a sister company invented. A few days later, the head of FTX's biggest rival, Binance, said the company would liquidate $580 million worth of FTX's in-house token. That set off a firestorm of drawdowns that FTX didn't have the cash to facilitate. Panic spread, tanking the value of FTT and more mainstream cryptos, including Bitcoin, Ethereum, and Solana. FTX faced a massive liquidity crisis. It needed a bailout, and briefly, it seemed it might be rescued by none other than Binance, a rival whose drawdown escalated the situation. But Binance bailed on the rescue plan less than a day after announcing it, saying FTX's problems were beyond our control or ability to help. On November 11th, FTX and Alameda filed for bankruptcy, and Bankman-Fried resigned as CEO of the exchange. "I F up," he wrote in a lengthy Twitter apology. So how exactly did this mind-blowing crypto problem go down very fast like this in a span of less than a week? Obviously, series of mistakes and mischiefs took place within FTX, FTT, and Alameda that I bet you would wish to know. So let me break them down in a much simpler language. Meanwhile, please subscribe to this channel where I will be bringing you such summarized explainer videos about personal finance, business, cryptocurrency, investment, and economies of the world that affects me and you. My goal is to reach this channel to 100,000 subscribers in future, and therefore your subscription counts even if we are less than 1% of our target. So, click that like button and subscribe. Let's get back to the breakdown. What is FTX? FTX is a digital currency exchange, a platform where people can buy and sell digital assets like Bitcoin, Dogecoin, and Ether. Such platforms rose in popularity in recent years as more people look to invest in cryptocurrencies without the hassle of dealing with the technical side of such transactions, such as setting up a crypto wallet. What is FTT? While FTX is a digital currency exchange platform like Binance, Kraken, Coinbase, and Gemini, FTT is a digital token created by FTX similar to cryptocurrencies like Bitcoin, Ethereum, Solana, and the likes. Many crypto platforms now make their tokens to encourage people to use their services by offering perks associated with their token. As such, tokens can act like a stock on the same platform it was created. So in simple terms, FTT is a created token of FTX company. These digital tokens use blockchain technology, in which computers contribute to a shared ledger that can be used to track digital assets. The first blockchain project, Bitcoin, relies on many computers competing against one another to create a distributed system that no one computer can control. But not all blockchains, cryptocurrencies, or tokens work the same way, and many are no longer distributed as Bitcoin. Tokens on a blockchain can be created by a single entity, as was the case with FTT, which was minted by FTX company and given out as a reward to users. FTT was also less transparent than other tokens, making it hard to track how many tokens had been created. People could buy and sell FTT, but trading was relatively limited. Other platforms also held the same token. An example of such platform was Binance. I hope so far so good and you are following keenly on how FTX company created its own Bitcoin-like token called FTT and started printing it at will for people to trade on it or hold it as an asset. So how did FTX company become so big? The company, founded in 2019, quickly rose to international prominence through high-profile acquisitions, aggressive marketing strategies, and low trading fees. Competitor platforms include Kraken, Coinbase, and Gemini. Even those unfamiliar with the technology were lured to FTX with promises to park their money in accounts and earn much higher yields than traditional banks. Major venture capital groups also bought in, investing almost $2 billion in the company. Sam Bankman-Fried, FTX's 30-year-old founder, became the face of the company and, to some, crypto at large. Celebrity endorsements and major sports sponsorships made FTX hard to miss. While all this was fame and celebration of FTX company was happening in public, some heavy mischief and mismanagement was boiling and ready to explode. So what were the first red flags? Not long after Bankman-Fried started FTX, crypto began to boom. The Bitcoin price, which had traded at around $10,000, shot up in 2021, peaking at more than $64,000. Venture capital money flooded into all things blockchain and crypto platforms moved to attract customers beyond the technologists and blockchain evangelists that once fueled its rise. The price of Bitcoin, generally seen as an indicator of the broader crypto market, declined dramatically from its late 2021 heights. It now trades at around $16,000. Other crypto and token values followed suit. The broader crypto industry decline had already forced many major platforms to shut down, but FTX seemed immune, even buying up some of its struggling competitors. But things began to change earlier this month when the balance sheet of a crypto investing firm owned by Bankman-Fried, Alameda Research, was published by CoinDesk, a crypto-focused digital media website. It showed that Alameda held a large amount of a digital currency created by FTX called FTT. And though that FTT held a certain market value, if the price were to drop, Alameda would be at risk of insolvency. House of Cards. FTX appointed a restructuring expert, John J. Ray III, as CEO to shepherd what's left of the firm through bankruptcy. That involves taking a hard look at the company's financials and figuring out exactly how much it holds in assets and liabilities. It's only been a week, and Ray has declared it's the biggest mess he's ever encountered. That's coming from an executive who made his name overseeing the liquidation of Enron, the largest bankruptcy reorganization in U.S. history. Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information as occurred here, Ray wrote in a court filing last Thursday. The filing contains evidence of colossal mismanagement and potential fraud under Bankman-Fried's leadership. Bankman-Fried hasn't been charged with any crimes yet. His lawyer didn't respond to CNN Business request for comment. Crypto contagion. The crypto industry is on edge, waiting for the next dominoes to fall. Soon after FTX went down, crypto firms were inundated with requests from customers seeking to claw their money back, the crypto equivalent of a run on the bank. Several firms have been forced to suspend withdrawals while they sort out their liquidity problem. In the crypto world, the minute you see a company or firm announce we're temporarily halting withdrawals, yikes, said Daniel Roberts, editor-in-chief of Decrypt Media, a crypto-focused news outlet. You put them on death watch immediately. Unusually, someone says, we're halting withdrawals, and then they say, okay, withdrawals back on, we're good. Among the firms at risk is lender BlockFi, which said it has significant exposure to FTX. BlockFi has suspended most operations. According to the Wall Street Journal, the company is preparing for a potential bankruptcy filing. The pain isn't confined to crypto companies. Venture capital firm Sequoia marked down its $210 million investment in FTX to zero. Similarly, the Ontario Teachers' Pension Plan, which invested $95 million, said it now believes that investment is worthless. Roughly 1 million others may have lost all the money they put into FTX. Binance efforts. Binance stepped in as a potential lifeline for companies hit by FTX's collapse. Its CEO Changpeng Zhao said on Monday that his team would establish an industry recovery fund for projects facing a liquidity crisis. Binance and others have quickly distinguished themselves from FTX, assuring customers and investors that their financials are on solid footing. Zhao, who goes by CZ, told CNN's Anna Stewart that an FTX-style collapse is not a risk for Binance. Asked what he would say if all his customers wanted to withdraw their money at once, CZ replied, yes, no problem. We have always been profitable. An unbalanced balance sheet. What was not yet the public was the extent of the connections between Alameda and FTX, or just how bad things had gotten for Bankman-Fried's company. Those connections became clearer in the days following FTX's move to stop withdrawals following its financial challenges. Media organizations, including Bloomberg, the Financial Times, the Wall Street Journal, and others, cited anonymous sources saying that FTX needed $8 billion to cover the gap between what it owed and what it could pay. However, Bankman-Fried said in an interview on Monday last week with a Vox journalist over Twitter DM that he needed to raise $8 billion in the next 2 weeks to make things right with account holders. The Wall Street Journal and CNBC, citing anonymous sources, reported that Alameda had used FTX funds for trading. And in the Vox interview, Bankman-Fried confirmed reports that funds had moved between FTX and Alameda, adding that he thought Alameda had enough collateral to cover the moves. Soon after, blockchain analysts tracked the flow of $400 million of assets out of FTX accounts, though it was unclear why those funds had been moved. In a series of text messages to Reuters, Bankman-Fried denied funds had been furtively funneled from one company to the other. He blamed the transfers on an internal mislabeling issue. However, it is difficult to ascertain how and why the company's funds were handled the way they were, according to a court filing from FTX's current CEO John Ray, who helped navigate Enron through its corporate bankruptcy process in the early 2000s. That's because FTX and its sister companies allegedly didn't follow standard financial reporting procedures. Normally, a business produces balance sheets several times a year that provide reliable information on the company's assets, what the business owns, and its liabilities, what it owes, among other things. But the balance sheets of Bankman-Fried's firms were never audited according to the company's bankruptcy court filings, meaning there is no reliable account or paper trail of what money the company had and where it went. Ray called FTX's poor management and financial opacity unprecedented. Never in my career have I seen such a complete failure of corporate controls and a complete absence of trustworthy financial information as occurred here. Ray wrote that the company has thus far secured $740 million of cryptocurrency held by the various companies that made up FTX and Alameda, which is only a fraction of what they hope to recover. Quirky genius turns pariah. At the heart of the entire saga is an enigmatic 30-year-old who managed to charm his way into powerful circles dominated by celebrity lawmakers like his $50 million Biden campaign donation, and deep-pocketed investors. In recent years, SBF, as he's known online, appeared on the covers of Forbes and Fortune, hailed as the crypto world's Warren Buffett. He accumulated a vast personal fortune, estimated at $26 billion at its peak earlier this year. All of that went up in smoke as FTX unraveled. His fortune was completely wiped out, and now his companies are under investigation by federal prosecutors in New York and Bahamas investigators. SBF had become a fixture in Washington too, where he regularly traveled to lobby lawmakers for greater regulatory clarity for the crypto industry. But since losing his companies, SBF has been tweeting erratically and told a Vox reporter that all of his DC trips were little more than white hat posturing. He even added, "F regulators." He told Vox in the interview conducted over direct messages on Twitter. They make everything worse. Investigations and regulatory scrutiny. FTX said that its representatives have been in touch with dozens of federal, state, and international regulatory agencies since the problem started. In addition to the Southern District of New York's FTX is reportedly under investigation by the Securities and Exchange Commission and the Commodities and Futures Trading Commission, according to multiple news outlets. In the Bahamas, where FTX is based, authorities opened a criminal investigation shortly after the firm filed for bankruptcy. On Friday, 18th of November, a powerful subcommittee in the House of Representatives said it was seeking internal documents and communications from Bankman-Fried and FTX to understand how the crypto exchange collapsed so suddenly and what is being done to recover customer funds. Can crypto survive? In short, yes, but there will be a lot more pain. In the short term, FTX's collapse has destroyed trust, said Matt Haugen, CIO at crypto asset manager Bitwise. The marginal crypto investor will now think twice before signing up for an account, and many institutional investors will sit on the sidelines waiting to see what other platforms or coins will drop. Many observers have compared crypto to the dot-com bubble of the late 90s. Plenty of companies went bust, but those that survived, like Amazon, emerged to become the cornerstones of the tech industry. Another historical comparison making the rounds is the fall of Lehman Brothers in 2008, which set off a global financial crisis. Crypto optimists might quickly point out that Lehman didn't take all of Wall Street down with it. Skeptics might counter that that's only because the US government intervened, a highly unlikely outcome in the largely unregulated world of crypto. There are attempts to make sufficient cryptocurrency regulations, but this disaster has nothing to do with crypto in and of itself, said economist Pete Earle of the American Institute for Economic Research, a think tank. It's about fraud and the power of virtue signaling. He added, this scandal, far from destroying crypto, practically ensures that crypto will be around for a long, long time. That being said, please guys subscribe and like this video because I am beginning to track when I will reach 100,000 subscribers in the near future. That's why I am calling for 100% subscription and like rate. You can also give a comment. Meanwhile, you can watch the two videos popping up on your screen. They have a close resemblance.